Question number 3I. On 1st of June 2016, the financial manager of Gazette Corporation's Pension Fund Trust is reviewing the strategy regarding the fund. Over 60% of the fund is invested in fixed rate long-term bonds. Interest rates are expected to be quite volatile for next few years. Among the pension fund's current investment are two AAA rated bonds. So there are two AAA rated bonds. First is zero coupon 2031. Second is 12% Gilt June 2031. Interest is payable semi-annually. Gilt stands for the government security. The current annual redemption yield to maturity on both the bond is 6%. The semi-annual yield may be assumed to be 3%. How 3 is calculated? Half of 6. Both the bonds have a par value and a redemption value of 100 rupees. So face value and the redemption value is same 100 rupees. You are required to estimate the market price of each of the bond if the interest rates or interest yield increases by 1%, decreases by 1%. So we are required to do the answer 1 and 2. In 1 there is an increase and 2 there is a decrease. So 1 is required to be made for like zero coupon bond and semi-annual. In 2 again zero coupon bond and semi-annual. So total 4 calculations are required to be made from the given information. I want all of you to give me answer for this first calculation. I just explained to all of you friends. In case of zero coupon bond, there is no cash accrual in between. You are going to get the amount directly at the end of the 15th year. How this 15th year is calculated? 2031 minus 2016. That is at the end of the 15th year you are going to receive the amount. How much? 100 rupees. The same is discounted at the rate of 6%. How 6 is calculated? 6 will be discounted at 7%. How 7 is calculated? 6 plus 1. So we understand that say 1 divided by 1.07 raised to 15th year. We compute the present value and based on that say P0. So P0 is 36.24. That is the way the answer is calculated. Please take down answer. In that first question, for semi-annual, try to do answer on your own. Let us see that say how to make the calculation of answer. It is again the 12% Gilt bond. In that, it is 2031 minus 2016. So it comes to 15 years. So 15 years, every year you are going to receive interest for 2 times. So in case of the number of years, we will take 1 to 30. And in the last year, you will take 30th year. What is the face value of the security? Face value of the security is 100 rupees. What is the rate of interest? The rate of interest is 12%. So what will happen over here? 100 rupees into 12% into 1 by 2. So it is 12 into 1 by 2, that comes to 6. Last year you will receive 100 rupees. Now the discounting will be made not at the rate of 7% but at the rate of 3.5%. And you can see that over here you have been provided with the discounting factor at the rate of 3.5% for 30th year It is 0.3563. So it is provided as 0.3563. Now 1 to 30th year, say the annuity factor is required to be calculated. So let us see that whether annuity factor is provided to us or not. Present value factor, present value factor, present value factor. Annuity factor is not given. So it is required to be calculated by us. PVIFA at the rate of 3.5% for 30 years. It will be calculated as 1 minus 1 divided by 1 plus I raised to n whole divided by I. This is the simple formula that we have. So over here 1 minus 0.3563 divided by 0.035. With that, we will make the calculation of answer. So 1 minus 0.3563, that is 0.6437 divided by 0.035. So 18.3914. That is the way we can compute the answer. So it is 18.3914. So 6 into 18.3914. So 110.35. And in the last year it is 35.63. And that will be useful to calculate the P0. 110.35 plus 35.63. So 145.98. That is the way the P0 is calculated. Please take down answer. A student is asking that, say, what is the use of the 60%? The simple answer is that, say, this is of no use to us, because we understand that, say, we just have to do the valuation of the individual security. So this 60% information is like of no use to us. Dear students, as far as the annuity factor is concerned, this PVIF at 3.5% for 30 years, that you can calculate by multiple methods. One of the method by which you can do is one of the method by which you can do is grand total button. So in that case, what you have to do, 1 divided by 1.035, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. 21, 22, 23, 24, 25, 26, 27, 28, 29, 30. You press is equal to for 30 times, then you press GT. You will get the answer 18.3920. The second method is, you can go with the memory plus button. So it is memory plus for 30 times, and then you press memory recall. That is the next method. And the last method that you can have is formula. As far as the formula is concerned, the formula works like this. It is PVIFA at the rate of 3.5% for 30 time period. So it is 1 minus 1 divided by 1 plus I raised to n whole divided by I. This is the formula. So the formula works like this: 1 minus 1 divided by 1.035 raised to 30 whole divided by 0.035. Now this value is nothing else but it is the PVIF. This is nothing else but it is PVIF. So it is 1 minus PVIF at the rate of 3.5% for 30 time period whole divided by 3.5 percentage. So that is the way what we can do, my dear. It is 1 minus PVIF. So whatever the answer that you get is the numerator divided by 0.035, and with that, so we can get the PVIF. Chalo, 2A and 2B. There are two questions in question number 2. I want answer of both of them from your end. Please write an answer. Answer for the second part of the question. Please write an answer along with me. In that, zero coupon bond. Let us see that's how to do answer. We understand that the required rate of return is decreasing by 1%. Okay. Presently, what is the required rate of return? It is 6%. From 6, it will reduce to 5. And with that, we are required to find answer. Calculation of P0, comma, if cost of capital reduces by 1%, full stop, it reduces from 6% to 5%. That is the way we are required to find answer. So it is once again we will take directly 30th year. So in the year column 30, redemption value is 100. Discounting rate is 5%. So in that case, it is 0.2314. So present value is, sorry, time period will be taken 15 years. Sorry. 15 years. I'm sorry. .4810. So it is 48.10. So P0 is 48.10. Read an answer. Second part of the question. In that 12% gilt bond, in that case, we will have the cash flow series similar to this. So column number 1 is year. Column number 2 is cash flow. Third column is 2.5%. This 2.5% is calculated as 5% into 1 by 2. Then finally, present value. So the time period will be taken 1 to 30. and 30th period. So 100 into 12% into 1 by 2. So that comes to 12 rupees into 1 by 2. That comes to 6 rupees. Last year you will get 100 rupees. So over here 2.5% 30th year factor is provided to us ready made, and that is 0.4767. So over here it is 0.4767. Now this is required to be calculated, and for that a simple process I have told you, friends. PVIFA at the rate of 2.5% for 30 period is equal to 1 minus 1 divided by 1 plus I raised to n whole divided by I. That is the way we will apply the formula. So 1 minus the PVIF is 0.4767. 1 minus 0.4767 divided by 0.025. So 0.5233 divided by 0.025. So 20.932. So friends, over here it is 20.932. Multiply with 6 rupees. So 125.59. In the second one 47.67. So 125.59 plus 47.67. So 173.26. That is the way the P0 is calculated. So this is the way for the different required rate of return the price is supposed to be calculated. Friends, over here I hope that all of you must have noticed it, that when the cost of capital increases the price will fall down, and when the cost of capital reduces the price will go up. So the price of the security that we have calculated in the second part of the question would be more. So this is 48, which is greater than 36. This is 145 and this is 173. So the cost of capital and price of the security have inverse relationship. That is what we understand, and accordingly we can observe even the answer over here. See, nowhere you are required to mention these things, but this is what you need to have understanding. Other logical concept that we already have studied is like this, that the rate of interest is 12%. Redemption value is equal to the par value. Now the required rate of return is per annum 5%. 5 is less than 12. That is the reason the price of the security is bound to be at premium. So the answer is greater than 100 rupees. This is the way we understand that the price of the security will be at premium. Why? Because the required rate of return is less than the rate of interest of the security. So these are certain things that we can observe over here. Dear students, one more point I think that you must have observed, that there are 4 questions that we did. In question number 1, number of students who have given correct answer were less. In second, increases. Third, increases. In fourth, almost everybody has given correct answer. So gradually only you will be able to give the correct answer with the understanding of the question.